Hey, you may not realize it, but Kevin O'Leary of Shark Tank and CNBC fame is also the chairman of a group called O-Shares ETFs. Kevin and I were co-interviewed by the CEO and president of that firm, Connor O'Brien. I think you're really going to enjoy this as we dive deep into practice management and high net worth issues. Have fun.
This is The Rare Advisor, proud to be a part of the Advisor Advancement Network and home of a business model supercharged by recurring and repeatable events. Your host is Mike Walters, CEO of USA Financial. He is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor.
Good morning. I'm Connor O'Brien, CEO of O-Shares ETFs, and today we have a very special program with USA Financial focused on RIAs, how they work, how they grow, and a lot of the services Mike and his firm can provide to RIAs. We also have Kevin O'Leary, who's going to kick us off really with a bit of a description of what he and other high net worth clients are looking for from an advisor. Kevin, good to see you.
Great to be here, Connor. Thanks.
So I know the story of what you would like from an advisor, and you've helped so many companies get through a successful exit and amass a family fortune in each of those cases. Tell us the story of how you guide them through selecting an advisor, and what is it that you tell them that they should get from an advisor?
Yeah, so we have over 35 companies that are involved in many different sectors of the economy. They're all private, and so what I find, because I've been doing this for quite a long time now, is when a company sort of passes 100 million in sales, generally these are consumer goods and services companies, although there's some technology ones as well. They're making about 15% pre-tax, sometimes a little better, but that's sort of the bogey that a well-optimized private company, often family run. And we get approached by strategics, we get approached by SPACs, that's relatively new, and we get approached by private equity firms. And so right now in our portfolio, we've got 3 of those under contract. And generally these are, people in their 40s, maybe early 50s that have run this business for quite a while, and they're doing their first exit. And, let's just take some round numbers. Let's say they're selling for 120 million cash after tax, about 100 million. I've known them for years. We've been shareholders with them a long time. These are great liquidity events for them. And so here's some observations, having done it so many times now, that I think advisors should consider. Many of you will know this already, but just to reinforce these points. So high net worth person, the entrepreneur, generally speaking, is a terrible investor. I've seen this happen countless times. They have been so myopically focused on running their business for this period of time that they've never really learned what it takes to manage a diversified portfolio at all. And that's not unique. So they really need help. Generally, it's the spouse or the significant other that was running the family, getting the kids through college, all that stuff, and they kind of mitigate the family's risk during that period. So my first piece of advice, as I've learned, because I often go on these Zoom calls with these families as we listen to teams pitch their services for, and generally, at 100 million, a lot of people consider family office. It's not really enough to do that. It's not really a good idea anyways, because what happens with family offices, as I point out to them, is that you really end up having the profile or the personality or the portfolio of what interests the people you hire to manage the money. So maybe go really long real estate, maybe you're really long commodities, maybe you're really long, one sector or another, because that's what the people that you hired know. Not good. It's much better to give. Usually our case, if it's 100 million, we get we do institutional diversification. We split it into two $50 million tranches and we shop teams. And so here's some of the really interesting experiences I've watched. People that make $100 million, I don't care if it's 20 million, it could be 10 million, do not need to beat the market. They've already beat the market. What they really want from you, even though they may not articulate it, is preservation of wealth. These families generally want to peel off maybe 3 or 4% after tax, distribute to family members or whatever they put into their trusts as they build them. Often they'll do generational skipping trusts to be managed, whatever it is. But the point is, they don't, going out saying, look, we beat the market. We're always beating the market. They don't care. I mean, that's not what they want. They want preservation of wealth. That's what they care about. That's really their number one concern. And so that would be, I've often joked, if I were an advisor, I'd simply say, to people that I'd say, look, I'm not here to beat the market. I don't try and beat the market. I try to preserve your wealth. And if you tell me your bogey's 3% after tax, I'll get you that. They don't care about fees. They're going to get the best deal anyways. I mean, you give somebody 50 million, you're going to get a really good fee charge. Everybody understands that. The other thing I've seen happen of late that I would really consider is people, and I'm guilty of this too. I'm going to describe this phenomenon. Let's say I give you a $10 million mandate to run convertible debentures, because I use ETFs for my equities, but for the fixed income side of our trust, we use managers for all kinds of different income streams, converts, prefs, credits, bank loans, factoring strategies, whatever it is. And that portfolio, we try and make 6% a year. We don't. We make about 2.4 right now because credits are very expensive. But the point is, I give you a $10 million mandate. I'm not really worried about your fees. I think I'm paying for that 34 basis points. But whatever it is, I'm going to pay that. I'm expecting you to make me about 2.4%, which is about what they're making. I don't read any of your communications. I don't have time. I don't read the research. I don't have time. That's why I hired you in the first place. But I do look at the monthly statement. I don't even read the positions. I simply look at the number at the back page on the bottom right that says, if it says 12 million, I'm really happy. It doesn't really change anything for me. I'm very appreciative. But if it says 9 million, I go out of my mind. I just go out of my mind because I paid you to preserve my wealth. My point, and this is a phenomenon I've seen many times. So really what I'm saying to you is, you don't get paid to take risks. So why are you doing it when you have a high net worth client like that? Why would you do it? They don't want you to do it. And the last point, which is a little humorous, I guess, but it happened to me. I was helping a family that had an exit, and they had two kids. One was 32, and I think the daughter was like 26 or something. And they were on the call. I was introducing them to two really seasoned veterans in the fixed income space on corporate credits, guys I've used for a long time. These guys have seen every kind of market. They are not spring chickens. I think one is in his late 70s and the other one is in his early 70s. And they look like it too, but they really know credit. And I told them, look, I've used these guys. They're great guys. And after the call's over, it's a Zoom call, the 32-year-old guy calls me up and says, Kevin, why would you introduce us to those two dinosaurs? Those guys are going to be dead by the time I inherit this money. Like, I don't want that. I want continuity. And I thought to myself, wow, I thought I was doing them a huge favor. The point is, have somebody young on your team that can relate to those family members. We're all old geezers. Don't bring out the old geezers only. Have some young millennials that are part of your team that show the continuity of a long-term management strategy. This is good advice. I've seen it happen 3 times now. Young people don't relate to dinosaurs. And so that's very important in gathering in wealth. Those are my 2 cents, Connor, just observations.
Some great things. I love that line, don't tell them you're going to beat the market. They already beat the market.
Yeah, it's true.
And lower the bar. Yeah. I mean, don't tell them you're going to knock the lights out and that sort of thing. And the diversity of the team is, I think, a really important one as well, because many people who built a business are now in their, who knows what, 50s plus, bring some 20, 30-year-olds into the equation. So, Kevin, we're gonna bring you back on in a few minutes. We're just going to hear Mike's story of USA Financial, how he built the RIA, and then the set of services, Mike, that you have and your team have built up so you can help other RIAs get to from the hundreds of millions into the billions in terms of their total size, and then perhaps as they get later on in years do the transition to their team or to sell their business. So 3 segments, Mike. Let's talk first about you and how you became a successful CEO of USA Financial.
Thank you. Thanks for having us. Really appreciate it, Connor, and obviously thanks to Kevin. And he made a couple of points that we'll definitely want to jump off of as we go through with this, because some of the things that he said falls right in line with how you create value from a business perspective in a financial advisory practice. taking it from being a sole proprietor or a technician, if you will, and then actually elevating it so that you're truly running a business, something that's creating enterprise value for yourself. So my history is with USA Financial. I am the CEO. We've been doing this for 33 years now, and kind of our claim to fame, if you will, is we really focus on powering advisors' legacies, specifically meaning that we are here to amplify the enterprise value for an advisor and an advisory's practice. So we focus on client and asset acquisitions. We focus on business scale and expansion, and then obviously at the tail end or as a growing mechanism, strategic succession, including M&A. So our business structure is kind of a hub and spoke of 7 different subsidiaries, and we orbit around an advisor's practice so that we can lend our horsepower to their practice to elevate them to the next level. So it really is like putting the pieces of a puzzle together. Every advisory practice is coming to us with a different set of circumstances, a different set of areas that they really excel in or areas that maybe they're struggling with. And so we kind of put the pieces together, and we have such a diverse collection, having these 7 subsidiaries that are there to work with them, that we can kind of bring together a business model and a growth strategy for them in ways that they most likely haven't experienced anywhere else.
So Mike, I think some people on this call, on this event, know USA Financial, and some maybe don't know so much. And what is the scale of and style of your RIA business, the wealth management business?
Sure. So actually, that's a little bit of a multi-staged question. So I'll just try to keep it brief. But we run, as I mentioned, multiple subsidiaries. 3 of them are actually on an RIA chassis. So we have USA Financial Securities, which is a broker dealer and corporate RIA. So those who are IARs, those who need oversight, supervision, various other back office supports, and so on, they would potentially utilize services from that firm. We also have a second RIA, which is known as USA Financial Formulas. That is our third-party asset management firm. We focus on what we like to coin as formulaic investing strategies. We generally are focused on the equity side of the business, and everything is kind of formulaic based, or as you would say at O'Shares, rules based in terms of how we approach the market. And then the final and honestly fastest growing segment for us is USA Financial Exchange, which is a TAMP platform that we have created. So not only our own asset management and models are loaded in there, but also various other asset managers use us as their backbone. So it allows an individual advisor, an RIA, or an IAR to tap into the scenario. In fact, Kevin kind of alluded to this a little bit in his description, which I thought was wonderful, in the sense that I think that in today's environment, that TAMP structure is one of the most important things that an advisory group needs to have to kind of streamline the process of running their business so that they can bring all this expertise to the table. Because as Kevin pointed out, generally speaking, your higher net worth clientele, they are coming from a different business segment. They have sold a business, they have grown a career, they maybe got an executive level at a large company, or they bootstrap themselves from an entrepreneurial standpoint, and they have a hyper focus and a great depth of knowledge in their industry, but that may or may not relate over to the financial area. So oftentimes what the advisor is really bringing to the table is the ability to create professional contrast. They're not just there to pitch an investment or try to get a return or a yield, as Kevin pointed out. They're really there to assemble the team, to be your personal CFO, so that you have someone working for you who has all the right connections, knows how to develop a portfolio, can identify based on what you're trying to accomplish for that investor, can identify, what asset managers and what philosophies are needed. And that can change over time because, again, the accumulation phase is actually the easy part of the equation. It's once they've sold that company or they've pulled the trigger on retirement that now suddenly you're living off the assets that you've accumulated, and you have to now create income streams, assign job descriptions to each and every one of the accounts or the holdings that you have, and that's where the complexity comes in, and that's why you want to really be in partnership with your financial advisor.
Makes very good sense. There's some trends that we see. You know, we see a lot of advisors, they're FAs at the wires, at independents, they're RIAs. And there's a trend, obviously, it's become just so well known that a lot of people want to create an independent business, move from wherever they are to setting up their own RIA. And they can set it up with the infrastructure provided by Schwab or Fidelity or LPL or others. We're not really going to try and pick or ask you to pick the recommendation of how people should set up exactly in terms of which brand or chassis to go with. But what are the things people should be thinking about if, I have a visitor. Art, hey. I'm on a call here with a bunch of people.
Okay, sorry.
It's my host. Okay, great.
Car's downstairs?
Yeah, all set.
You all set?
Yep.
Be in touch. Thanks.
The bold new world we all live in.
There is the world. That's right. That's hilarious. So Art's family actually won the America's Cup way back.
Very cool.
Which is amazing. So that's an art story. So so the whole thing is this trend, and maybe just share with us a couple of examples of what you think are the successful ways for people to make that transition to becoming part of an RIA or setting up their own.
Sure. So we actually see the trend. It's interesting. The trend kind of goes both ways, and it depends a little bit on the circumstances and the structure of the advisory practice. So we have advisors who have over time, maybe they started out as having a relationship with a broker dealer, and they realized they wanted to get into the assets under management side of the business, which for a whole host of valuation reasons for their own practice and business is extremely important, not to mention it's of great benefit to the investor. And so they start to gravitate in that direction. Oftentimes what happens is they initially become what's known as an IAR, an investment advisor representative. So it's very similar to in the broker-dealer world where you have a registered rep underneath a broker-dealer. Here you have an IAR underneath an RIA. And so many individuals find that is the model that makes the most sense for them because they can leave the compliance and the back office issues and all the regulatory burden, or at least a large swath of the regulatory burden, to others who specialize in that area. And so we support a lot of advisors in that capacity. The flip side would be someone who says, no, I really want to be my own standalone registered investment advisor. I want to be that RIA myself. Generally, I would say, you really aren't probably a candidate for that until you're breaking through the $100 million mark of assets under management personally, because what you need to understand from an entrepreneurial standpoint is you now are needing to create additions to your team. You need someone to head up compliance and so on and so forth. I think one of the most dangerous positions that an RIA can put themselves into is if they're kind of like a one-man show. Meaning that the same person who is working with the clients, who is bringing in new assets and bringing prospects and customers to the firm, managing the portfolios, is also the person who, from a compliance perspective, is deeming that suitable, from a fiduciary standpoint. If that's the same person and you're now getting audited by a regulator, you're going to have a challenge on your hands because you've got a tremendous conflict there.
So what do you think? So what do you think is the minimum advisable core team structure? What number of people, what roles?
I think at the very minimum, you're looking at the lead advisor, the rainmaker, if you will, who's most likely the owner of the practice and the key financial advisor. Yeah. Generally speaking, to be a standalone RIA, you probably have at least a small collection of sub-advisors underneath you, even if they're more in like a junior capacity to support the rainmaker and the business that they're bringing in. You probably need 2 or 3 administrative and customer service type staff to keep you from getting bogged down in the things that, financially speaking, you should not be spending your time on. And then you need to flip over, if you're going to be that standalone RIA. Now you got to flip over to the compliance side. You're going to need someone who you should deem as your compliance officer. Depending on your size, maybe you can get away with just one person there, but oftentimes you might need a small team of 1 or 2 or 3 people, depending again. And I'm focusing on a retail registered investment advisor who's bringing in customers in a local geography.
But your cost structure is $1 million just to be in business. Your annual cost.
Yeah, exactly.
Yeah. So it's not a It's not a step to take with a small asset base.
Yeah, and the key really is, and then we can go whatever direction you want with this, Connor. But one of the keys really are to get to those levels. You need systems and processes in place, and that's not just administratively and compliance. That's also on securing new assets, bringing new customers in. You need the marketing plan. You need to be able to push certain buttons and flip certain levers, and with predictability, know what that outcome is going to be. If you're operating it like a sole proprietor, and the business is coming in the door based on your personality, it's hard to make a true business model around just that. And it's also very difficult down the road when you fast forward, if you're looking to sell your practice down the road to someone to retire or take on that next stage. Nobody wants to buy your job. They want to buy your business. And so you have to run it like a business.
But let's talk about that, because it's kind of the end game for everybody. Is at some point, monetize the success they've created. And I guess there are generically two ways to go about it. You can transition it to your existing team and let them essentially buy you out. Right. Or the other is just do a straight up sale to some other RIA that's compatible. Just talk about those two scenarios and what really is the valuation and the structure that you see in those two scenarios.
Sure. So the scenarios, I would say, generally speaking, if there is a junior team in place who has the skill set and can rise to the occasion, most financial advisors, whether it's right or wrong, most financial advisors choose to go down that path. And it is nice because it creates some semblance for not only for the next generation internally, but also for the clientele. Kind of to what Kevin's point was earlier, if you've got the dinosaurs, so to speak, we have the younger gen, the next gen sitting there to continue to take it on, and there's already a level of comfort there. So normally what happens in those scenarios is we create like tranches, and we'll go and have that buyout take place over time. Again, it's a very friendly relationship. There's not the same kind of negotiations that go on if you've got, an outside entity buying you, if you've got, whether it's a strategic, whether it's another financial advisory who's looking to merge in what they're purchasing from you, or whether it's even a PE or a roll-up type deal. Those tend to take on a little bit different nature. And those tend to be more the traditional type stuff that quite honestly, Kevin probably knows greater detail on that structure than I would, even though I might know some of the little things to look for inside of the financial services firm. But in terms of like that first bite of the apple, that second bite of the apple, that you see more when an outside firm is coming in to make that purchase versus handing the reins over to the next generation. And one of the key things that a lot of people miss on the valuations, well, first I should state the obvious, which many people on this will understand and already know, and that is recurring revenue in our industry is valued significantly higher than is transactional revenue. Recurring revenue basically meaning fee revenue, assets under management, assets under advisement, things of that sort. One could potentially even argue 12b1 fees, things that are going to continue to come in regardless, as long as the business stays in the books and the relationships stay intact. Versus the transactional stuff, which is more commission-based, whether it's a front-end annuity sale or any mutual fund brokerage type sale, whatever the case might be, where there's a commission generated. So we're seeing about a 250% difference in those valuations. So about 2.5 times greater value is being placed on the recurring revenue piece as is on the transactional revenue piece. And then one of the really important things, and I want to bring this up because it ties so tightly with what Kevin was saying earlier. When you get into his dinosaur example and the transitions and so on over time, it's shocking. A lot of advisors know that one of the big risks they run is when people die and what happens to that money, but they don't usually know how significant that is. So there's some stats that came out from actually Investment News, I think co-opt on some kind of a study not long ago. And the shocking numbers, so there was a whole bunch of numbers in there. The three that I really pulled out was that 70% of all married women will experience widowhood. So 70% of married women will experience widowhood. Combine that with the fact that 70% of widows will fire their financial advisor after their spouse dies. So think about how significant a chunk of assets that is.
Yeah.
And what it also tells us is that advisors in general are not doing a good job of managing the entire relationship. Oftentimes what happens is they're focusing on the one individual in the marriage who is the financially oriented individual, and the other person kind of sees like, oh, that's their plan. Now, historically, that's been somewhat male dominated. That's changing very rapidly today. But I think that's why that stat is so significant, that 70% of widows are firing their advisor after the spouse dies. And it's because they felt like that was their husband's plan. That wasn't their plan.
For all advisors, whatever firm, whatever setup, that's very important to know, because they've got to get engaged with the couple and even the next generation and so on. We're going to run tight on time here, Mike. I want to just ask you, just throw a number out there for people. So let's just say I had an RIA, $1 billion, $6 million of revenue. What are my exit choices? What's the valuation I could expect to get?
So super generic. And actually a really good tool. I see they have it on the screen right now. If you want to get a bunch of information on how the valuations work and actually get the numerics, if you go to that advisorbluebook.com, you will get about a 15-page write-up explaining all the dynamics. It's kind of like, getting a Blue Book value on your car. It's not an appraisal. You'll still, if you get to that point, you're going to want to go get a full appraisal, but this will dial you in to what some valuations are in your firm. But again, generally speaking today, again, this is really horseshoes and hand grenades, but our numbers today are coming in at about 2.53 multiple on recurring revenue. If you're just going off revenue, this is, this is ignoring EBITDA and all the other important things. 2.53 times recurring revenue, 0.97, so just under 1. 0.97 times transactional revenue. But that advisorbluebook.com will give you a tool that you can actually punch the numbers in, get the valuation, get the Blue Book, if you will, on your business. And there's also, I think there's about 20 or 25 video snippets that will explain a lot of the components that help you increase the value of your business.
So that's very helpful. People can go to that, and it's a great resource. So thanks for that. Give me CNBC has this thing called the lightning round. Let's give you the lightning round treatment on TAMP. What is your TAMP business like, and what are the services that an advisor, an RIA, can get from you and your TAMP services?
Sure. So what makes our TAMP unique is we vet all of the asset managers. So unlike some of the very, very large TAMPs who just load on as many asset managers as they can and let it all get thrown against the wall and you got to figure it out for yourself, we kind of vet them down, figure out managers that really play well in the sandbox together so that you can easily build portfolios that complement each other and the various components complement each other. I would say probably about 70% of the business on our TAMP is coming through with advisors, RIAs, choosing the various models and combining them together, kind of making their own custom composite models, if you will, based with these various asset managers. The other 30% is what the industry historically has called rep as PM, rep as portfolio managers. So the advisor themselves, the retail advisor themselves, whether they're doing all of it or a subset is usually what we see, where they're truly doing the management themselves in a certain area of expertise they have. They might be relying on other asset managers in areas they don't carry that kind of expertise. And what's kind of unique for us is we hand over the keys to the castle, if you will, in terms of how a retail advisor can actually execute models the same way a true third-party asset manager executes models. So we believe it's one of the first times that in the marketplace, a retail advisor can truly run a business as if they're a third-party asset manager, which means they can trade at the model level. They have sleeves that they can apply so that they're not having to go in and do all of this manual work to manage the portfolio. So it's really a streamlining effect for their back office.
Well, that sounds fantastic. I think we're going to have another call where we drill into that, do a deep dive.
Yeah, love to.
Definitely look forward to that. So I'm going to let you hear what Kevin has done with his family wealth and ultra simplistic, straightforward, logical way of allocating capital. And then you guys can just have a very quick debate, and then we're gonna jump off the call in just a few minutes. So Mike's going to critique what you're going to tell everybody, Kevin. Just your family wealth. You've made a shift of asset allocation that's pretty significant. Some people on the call have heard this. For others, it's new. So first, a significant shift, and then how is the allocation done?
Yeah. So, I mean, we've had the classic for the trusts, which are managed by trustees. I don't really get much of a say in it, but I certainly, know the trustees. And so we sort of talk each year. We've been 50% fixed income, 50% equity for decades. But this year in January, when we do our rebalancing, we did something new. We distribute 6% a year, and we have to earn it one way or another. And that's, over the decades, not been that easy, but we've done a good job. And we went to 70% equities, 30% fixed income, because our fixed income portfolio, which is investment grade and above, using all kinds of different instruments, was yielding about a 2.4% yield across just under a 5-year duration. So our bogey is 6%. We're way off the mark there. And I personally prefer equities at a time when there's a buoyant fourth quarter. The economy is doing quite well. Inflation risks are higher than they were a few years ago. So I'd like to have pricing power on my equities. And generally, if you go back in history, when inflation creeps back into the economy, you see pricing power in large corporate enterprises. And I use, obviously, O shares because I'm, an owner of the manager, and I like to eat my own cooking. And the OUSA is my largest holding, and we use that as the core equity for our trust. But 70% now, and the trusts are designed to be generational skipping in nature. My mother taught me something when I was very young. I was graduating from college, and she came to my graduation and said, "The dead bird under the nest never learns how to fly." And I said, "What the hell does that mean?" And she said, "It means no more checks. I've paid for you right to the end of education, and you're done now, and you're on your own." And I said, "Wow, that's pretty tough because I don't have a job." She said, "Yeah, go figure it out." And what she really hated was entitlement. She really felt as a matriarch that entitling a child with a risk-free future is a horrible disease. And I've watched this happen. Everybody knows really screwed up rich kids. I mean, it's just my personal philosophy. And when I had my liquidity event, I decided to build that into our trust. So our children are not entitled. They are paid full freight until last day of college. No matter how far they go, they can get a PhD if they want. It doesn't matter. And of course, there's specifics around healthcare and other things. I mean, where they're not completely abandoned, but there's no free money. And so they've done, and I remember explaining this to my kids when I had my liquidity event, what we were structuring in Boston at the time. And my kids were 4 and 7 at the time, so they just laughed it off. They didn't understand it. And later in life, when my son was doing very poorly in college, not in college, in high school, he said, "Explain the trust to me." I said, "Sure. If mom and I get killed in a car accident tonight, you don't have to worry. The trust will take care of you till you graduate from high school. And then after that, you're on your own because it doesn't look like you have the marks to get into college." And he said, "What?" I said, "Yeah, that's how it works. You read the agreement. You gotta get into college to get it paid for." And I guess at that moment, he realized the darkness of his situation, the uncertainty and the abyss that he was looking at. And he got to work, and he ended up graduating recently as an electrical engineer. He works at Tesla in San Francisco now. So he's on his way. And the trust did its job, but the matriarchal structure of that, and not everybody agrees with what I'm doing here, but I don't care. It's my money, and I'll cry if I want to. And it's just sort of the way that works. That trust is going to work for multiple generations, even if they have kids out of wedlock, doesn't care. And so it's this is the way I do it. And, other families do other things, but that money has to be managed to peel off 6% to pay for all the things it has to pay for.
Now, I know your kids are doing well. Your son's at Tesla and your daughter's doing ad production for some well-known companies. One last word just from you, Kevin. You said 70%, people might have got you wrong, or 70% is in equities, not all of it in OUSA. What is your composition of that 70% allocation?
So I love ETFs because I like the transparency, the efficiency, the low cost, and above all, how it works with taxes. It minimizes taxes. So with the in-kind transitions that occur, I'll disclose my holdings. I've got 40% in OUSA. That's the core. Then OUSM, which is the mid-cap, same rules-based approach to the Russell 2000, except the majority of companies in Russell 2000 don't make any money. I want the ones that do. And they're inside of OUSM. So that's, basically 60% of the portfolio domestic. Then I hold a 20% weighting in Europe, OEUR, a zip code everybody hates these days, but the values are very interesting. There's 50 top companies there like Roche and Nestle, American Tobacco. These are big balance sheets that pay distributions, some as high as 3%. I own those. And I want some exposure to the Swiss franc, the euro, and the British pound. And then lastly, for my growth, OGIG, I have 20% weighting in there. And that's my portfolio. It's nearly 1,000 stocks, very diversified, very tax efficient, totally transparent, and represents a very good way to, I think that 70% of my holdings are in those those 4 indices that are very rules based and work for me.
Nice. Yeah. And people who want to get information, they go to info@oshares.com, ask us for info. Kevin Beals, our head of capital markets, will be in touch with you. And one of our salespeople, will also be in touch with you if you're in the region they cover. So, Kevin, thanks very much for that. Maybe just kind of a quick bit from you, Mike, on what your typical equity allocation is. How much of it's ETFs? How much is it active managers? How much is large cap domestic, small mid cap, and then what else? Whatever else you want to tell people.
So I heard you mention the word debate, and I actually agree wholeheartedly with everything that Kevin just said. So we,
nice.
You're looking at a
quick debate.
Yeah. You've got a multi-decade decline in interest rates, with Federal Reserve hitting 0 at that point. So the idea that those rates really have nowhere to go but up in the longer run. So that doesn't play real well for the bond market, for the debt market, as Kevin was saying. So generally speaking, we encourage people to focus more on equity, maybe using risk management tools that would take them out of equity if certain triggers were to occur. So again, kind of rules based, just being applied in different ways. And for in terms of the advisors who are working off of our platform, it really depends by the advisor and the customer if they tend to be more individual stock based, if they tend to be more ETF based, or most, quite honestly, are a combination of the two. And they're using different models to target different things. So we go through scoring mechanisms to kind of formulaically arrive at various data points, and we provide that to the advisors so that they can help make decisions, and we run models based on that for them as well. But the things that Kevin was just saying, I would simply echo. We're seeing the same things. 6 months ago or so, we were seeing the growth segments within the various index kind of leading the charge over the value. We saw a flip-flop as of late, and now the value segment tends to be rising. We're seeing materials, energy, financials in terms of the sector side starting to rise to the top, which was not the case 6 months ago. I think the market in general, and I'll just kind of leave it with this, it's had a rough go here the last month or so. It's trying to digest an awful lot, in my opinion, right now, coming off of a Trump pro-business orientation to a Biden kind of stimulus orientation, as we're seeing right now. We're dealing with the pandemic, historic in nature. We're seeing businesses trying to get back open. Last number I saw was I think we've got about 28 states open across the country right now, whatever open gets defined as. But I also saw that 34% of small businesses that were operating January of 2020 are no longer operating May of 2021. So there is a lot of undercurrent taking place. And I've heard Kevin speak before about the advancement of all the technology stocks and why you guys are so bullish on that with your ETF stock, or your ETF on the tech side. And, obviously our world has changed. Look at how we're communicating here. I haven't had a traditional phone call from a business perspective in months, because this is how we do it all. So everything's kind of, in movement, in my opinion, right now.
Yeah, some great info and all of that, good observations. So let's leave people with the address at which they can reach you or your team. Just to let people know that. And there we go. So encourage people to get in touch with Mike and his team and check out that information at theadvisorbluebook.com. Obviously, you can reach us, info@oshares, or whoever is your preferred contact on our team. Mike, Kevin,
you can always email me if you'd like as well. Just mwalters@usafinancial.com.
Great. All right. Well, Mike, really appreciate you being with us. Kevin, glad to have you on us as well. And thanks to everybody for joining us this morning.
Thank you. Appreciate the invite.